I'm Charlotte McLeod with the Investing News Network, and here today with me is Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. Thank you so much for joining me online today once again. It's always great to see you.
You bet. Happy to be with you.
Of course. And so we're going to pick back up on a conversation that we had in September. When we were speaking then, we were looking ahead to the end of the year. You said that we might see prices for oil at the $100 per barrel level, but you also reminded us that the sector was facing extreme volatility. So we're wrapping up the year with prices closer to $80 a barrel. What are the factors that brought us to these levels?
Well, I'm thankful that I gave myself an out. I did think that we would be at $100 at the end of this year. I thought, continuation of falling inventories, the signaling that China, we thought would be, signaling at least that they're going to be opening up in the end, largely the end of the SPR releases as people look to 2023, and then, the inevitability of some semblance of impact on Russian production from the EU embargoes. We thought, jeepers, you've had the steepest draw in inventories in history, the continuation of that trend. And so it's been disappointing. And it's funny, like I look at my fund, we're up 45% on the year, but I'm disappointed. And because I remember where we were in June. And so you reflect on, okay, what's happened? I think it's a combination of a whole bunch of things, as opposed to me being able to say this one thing is why oil sold off from like 90 to 70, and here we're trading at 78. I think it's one, commodity traders had an exceptionally good first half of the year. They were faced with a profound amount of policy uncertainty in the second half. So the SPR, the Biden administration post midterms were even saying, oh, gee, maybe we're going to draw down further and such. The EU embargo, it's had zero impact on Russian production, but there was, which has basically, frankly, been a bit of a letdown. But there was an expectation of, well, we're finally going to see a drop in production. What do we see in November? Russian exports actually went up 500,000 barrels per day as they tried to flood the market right ahead of the embargo. And then I don't think many people thought that the China COVID zero policies would be persisting for quite this long. That has impacted demand by 1.5 million barrels per day. So that's been huge. But I think, dominating that as well has been the recessionary fears and risks. So as a commodity trader, like you had an exceptionally good first half, you've got a month left in the year. Are you going to put your bonus on the line when, the volatility, we're going up 4 or 5% in a day, and really inexplicably? So that's a very weak explanation for why oil has sold off, but it's the best that I can come up with. You've got lack of participation in the markets, which is leading to excess volatility. You've got yet again this concern about, my gosh, if we go into a global recession, and I'm sure we'll touch on this, what the heck does it mean for oil? I thought any of these signs that China very clearly is opening up, like we've had everybody from Jeff Curry to Mike Tran at RBC saying, that's $10 to $15 per barrel going up, once the market actually buys into it. We had headlines coming in, oil was selling off on it. So it's been a really weird past couple of months which as a guy that, I'd really tried my best to follow fundamentals. There's been so many cross currents that we've had to deal with, but ultimately we think that inventories will be continuing to fall. We use Kepler, a data provider, for that information. So ultimately, so long as inventories keep falling, then that means the price will eventually normalize back to much higher levels.
Yeah, so definitely there's a lot going on. I think you've highlighted just all the chaos that we're having to face right now. We're going to pick up on a lot of the things that you touched on, but first I want to go for inventories. So you've told us before that inventories are really what you look at to get a grasp of what's happening in the oil market. And you tweeted probably a couple of weeks ago at this point, a great chart that was showing their decline. I wondered, for those who haven't seen the chart, I wondered if you could give us a sense of where inventories stand right now and what that tells us about the market.
You bet. So one of my original mentors in energy is a guy named Mike Rothman at Cornerstone Analytics, and he always says, okay, if there's one thing to follow, you follow inventories, because it's the nexus of supply and demand. It's your best indicator as to whether a market is over or undersupplied. Clouding that this year has been at the SPR release. So the administration releasing 180 million barrels out of US storage, 260 globally. And so in the face of that, because you would think, well, geez, you're releasing that, and that's not accounted for the inventory numbers. So, you'd think inventories would go up. But if in the face of that, inventories have been falling, which speaks to just how profoundly, I think, undersupply the market has been. With the admission, there might be some short-term noise. There's some chatter about, well, there's unaccounted for product inventories in China, and you've had Russia surge the market and stuff, but it's meaningless. So we in the medium term, we've had inventories fall this year using Kepler data by about 100 million barrels in the face of a 260 million barrel release from SPRs. So we're at multi-year low levels. People often say, well, geez, Eric, if you compare it back to like 2004, like we're fine, but it's so idiotic, because if we go back 10 years, well, demand's grown by over 10 million barrels per day. So on a days of supply, very clearly, you need more storage than back then. You can't just say, well, we're at similar levels, therefore we're similarly adequately supplied. So again, it's simple, but I say, well, 2023, we're starting the year at a multi-year low for inventory levels. What has been the obfuscating factor of the SPR release largely ends. I think next year it's 30 million versus 180. You've got China signaling normalization, that's 1.5 million. You've had the IEA, EIA, and OPEC all come out and say, well, they think Russian production will fall by 800,000 to 1.3 million barrels per day. And despite recessionary fears, the IEA just out this morning said, well, we think demand's going to grow next year by 1.7 million barrels per day. And global supply is only going to grow on a net basis by, I think it was 800,000. So the market is in deficit, I think, sustainably. Inventories will continue to fall further to multi-year lows. And ultimately that will put meaningful upwards pressure on the oil price.
Okay, so again, there's a lot to go over here, and we talk a lot about supply usually in these conversations, and you've given us in the past a few baskets to look at. One of them is US shale, which you've told us the hypergrowth stage there is over. So I wondered if you could talk a little bit about that basket of supply, particularly in relation to those SPR drawdowns that we've been seeing, because that seems like there is some relation there that we should pay attention to.
You bet. So let's put it into context. Without US shale growth over the past decade, non-OPEC production would have been flat. So largely the US shale has been the only game in town other than OPEC. So when I look at going forward, we've seen shale in 2022 massively disappoint. Many people, including the IEA, and they're saying the same thing again for next year. Well, we think shale is going to grow by 900,000 to 1 million barrels per day. So far right now, we're at a run rate of 600,000. And so we think that trend will continue, this disappointment of shale growth. And you said the line, we're no longer in an era of hyper growth, where it's this period of time when shale growth is growing in excess of global demand growth. And so why is that? Part of it's geology. We're seeing well results get worse. So when you adjust for the length of a well productivity is falling. Secondly, when you look at gas, wells are getting gassier. So again, it's evidence, I think, that many of these companies drill their very best acreage, and you're getting maturity in some of these basins. So the biggest reason, though, are guys like me that are saying our clients, our investors, need to be rewarded for the misery of the past 10 years, the worst bear market in history, and we're going to get rewarded by getting paid. And we're going to get paid with massive dividends and share buybacks as an attempt to re-rate the valuation levels. And so even if companies weren't facing an inventory problem, 10 years of inventory life or less, even if wells weren't getting worse, faced with inflationary pressures next year, 10 to 20%, i.e. you've got to spend more already to achieve the same result, ultimately it's the owners of the business that are saying, no, you will not. You will not repeat the sins of the past. So that's a very, very powerful setup. And it's the reason why I think the IEA, calling for over 900,000 barrels per day of shale growth, I think is misplaced. I think it'll be half of that.
Okay. And of course, on the note of supply, another basket that we talk about frequently is OPEC. So I believe we have heard from OPEC that in November and December, they will cut production by 2 million barrels per day. You've talked before about the depletion of their spare capacity as a really important factor that we need to watch in the market. So I guess the question is, what's the next move from OPEC as we head into 2023?
Mm-hmm. Yeah, I'm actually traveling there next month for the first time, so I'm going to get to visit with many of the officials. So I'm sure we'll have a good conversation following that trip. We had forecasted like a year ago, and it was a pretty simple call. if you wanted to kind of read the tea leaves, that OPEC would exhaust their spare capacity. And the reason for that is, again, they've endured a very weak oil price for a long time, and they went through a time frame where they could not cut social expenditures, lest you risk basically inciting revolt amongst your populace. So you cut spending on new projects. These countries are facing cycle times of 4 to 6 years. And it's the reason why Saudi Aramco and the UAE are both adding capacity, but it's not coming online until 2025 and 2027. So they reached capacity exhaustion, which I define as a sustainable level, like not surge production, including inventory drawdowns, but where you can sustainably produce. I think they were there. And then they cut, face on the nameplate was 2 million. It's really about 900,000 barrels per day cut. So they've got some production held off. And I think the reason for that is they want an insurance policy in case there actually is an impact on Russian production. And there's some people that saying it'll be zero, others saying 1.4. Well, that's a big variance in already an undersupplied market. So I think they wanted some production to be able to smooth out any supply shocks. But they've warned the world, to their credit, and they've said we can no longer shoulder the burden. Like we are doing our best. These are the most sophisticated companies on the planet. But they've said, look, at the global supermajors, it's your turn. You need to start investing. Otherwise, the crisis that we're clearly in today is only going to get worse. And it's a warning that still is not being answered. So I think for OPEC, they're doing their best. The haves and the have-nots. The haves are adding capacity. It's subjected to cycle time. And at the same time, my guess would be they're trying to defend a higher oil price, because they had a taste of finally getting back to a point where you're not burning, your foreign exchange reserves, where you're going concern because your oil revenue is finally meeting your budgetary requirements. For Saudi, you're into the 90s. Well, we're not in the 90s right now. So I think if we were to continue to languish, it's not the best solution, but I do think there would be another cut on the table if necessary.
Okay, and you mentioned what's going on with Russia, so I think that is important to talk about as well. We recently had the EU ban on Russian imports go into effect. There is a price cap involved as well. I wondered if you could explain to us those measures, what they're hoping to accomplish, and maybe talk about whether those goals are likely to pan out as expected.
It's a good topic to discuss, but I want to reiterate, you need not be bullish on oil because of a price cap or an embargo, what's happening in Ukraine, all of these things. You should be bullish on oil because the demand for oil is going to grow for the next 10 years at least, and supply growth is not, because of shale, OPEC spare capacity exhaustion, the global supermajors not being able to. Because I think the EU embargo on Russian crude and price caps, it's noise. It may have an impact that's additive to why I would be bullish on oil. And the reason why it may not be effective is that the price cap is designed to keep production flowing, but to try to stymie their revenue that they're using to weaponize and kill, innocent kids with. I don't think governments around the world are willing to accept any increase in energy costs, because you see what's happening in Europe, even California now with natural gas prices, et cetera. And so ultimately they have to answer to their electorate. It's depressing, frankly. We're all ESG, we're all, everything until we have to pay for it. And so you're seeing politicians cave in real time. So Russia said, well, look, we're not going to sell to anybody with a price cap. The price cap is an oil price higher than what they've actually been selling at already. So the net impact, I think, is going to be, probably not that high. There's another embargo that comes into place in February on products. Most people think that will actually have more of an impact. And so that's a to be determined. We've got three agencies, IEA, EIA, and OPEC, saying 800,000 to a 1.3 million barrel per day hit. We'll see. I'm counting on a big donut on that, because it has not had an impact yet. And in fact, it probably loosened the market a little for Q4 as Russia increased their exports by 500,000 barrels per day.
Okay, I think that's some really good context for what's going on over there. Now, I also want to mention your third supply basket that we usually talk about that you've alluded to already, which is the supermajors. So you mentioned that OPEC is really calling out for them to take some initiative here. Are they listening to those calls? What's going on there?
Yeah, it's a call that I don't even know if they can answer. And they can't answer it because you have politicians all around the world slapping companies with excess profit tax, like windfall profit taxes, right? We're seeing it in Germany, the UK, obviously, in Italy, in California. And so what is that doing? It's injecting so much uncertainty the companies literally are saying, screw it, like we're out. So like Shell said, okay, the UK, we had 25 billion pounds of investments planned, they're gone. And so I think if you're seeing the short-termism where we were already at historic levels of energy ignorance for policymaking, now we're like, okay, let's get some short-term votes because we'll slap these bad guys. Mr. Smith, I know you're paying more for your natural gas and power, so we're going after those naughty, oil and gas companies, and we're going to take their profits and we'll subsidize, consumption, which is again the opposite of what they should be doing. The net result is it's just going to exacerbate and elongate the supply crisis that we have. So you've got the equivalent of my philosophy on the other side of the ocean saying, share prices are cheap, you need to delever, you need to pay dividends, you need to do buybacks. So we're sitting at levels approximately half of where we were in 2014 from investment. That's going to fall even further next year. Most of the big projects that were sanctioned in the last bull market from 8 years ago have come online. And so, yes, there are some pockets of growth. Guyana is one, Canada, small. But on a net basis, most basins in the world are in decline. And that's what people don't figure out. So this is about 45% of global oil supply, where I reference a good study by Bernstein saying they estimate flat production between now and 2030. Well, that's 7 years. And that's a minimum 7 years of demand growth between now and then. Where is that production and where is to meet the demand going to come from? It's not the supermajors. OPEC has warned you to say it isn't us. And shale, I've got energy aspects saying, well, shale's peaking in a year from now. So it's that bullish mismatch between demand growth and supply growth, which again, we all have to tune out the noise. The SPR short-termism, the political move, the Russian embargo, what's it going to mean? Just dial in on those four things. You have to endure the volatility, but this is a 5-year plus call, which I think I know the destination, but we're going to zig and we're going to zag. But I have supreme confidence in terms of where we're headed.
Okay. And I recall that for you, the oil story is more of a supply story than a demand story. But you did start to talk about demand, and I think we should go into that a little bit further, what we may see in 2023 and any surprises there. I know we've got a number of things that we could talk about here. We have China opening up. We do still have recession concerns. So what are your thoughts?
So let's talk about recession, and let's talk about China, because there's no shocks in terms of substitution or anything. There's no fusion. It was popular this week, but if that works, we're talking decades and decades from now. So it solely comes down to what's the global economy look like, what does that mean for oil demand, and let's talk about China. So I think that one of the largest reasons why we've had this sell-off is concerns about a global recession. What does it mean for oil demand? And using the oil contract itself as a financial vehicle to express a negative view. I was doing a client call last week, and I started the call and oil was up $2. I ended the call an hour later and oil was down $2. And I pull up, go to Bloomberg, no headlines. The only thing that came out was an services ISI PMI number or whatever that indicated, higher inflation, therefore maybe higher Feds, higher, dollar rally and, sell oil, et cetera. So you've had this deviation from what fundamentals would suggest. So what does recession mean? We all suffer from recency bias, meaning we remember the most recent thing the best. And so that was COVID 2020, demand fell 8%. That's probably not the playbook we can use going forward. Prior to that was the great financial crisis in 2009, where demand fell by 2%. And so let's just assume that's our we're hours away from the financial system ceasing to exist as we were in 2009. Let's just go there. That's a 2 million barrel per day hit to demand. Offsetting that, the SPR is 1 million, give or take. China normalization is 1.5 million. And Russia, if there's a production impact, where I'm hearing is over 1 million, give or take. So I think I just got to 3.5 million, which is over 1.5 times the demand impact of a great financial crisis, which is not a scenario that any mainstream economist is talking to. So prior recessions to that have been a moderation in the rate of growth in demand, not falling demand. The prior two recessions, demand still grew. So we're already undersupplied in that inventories continue to fall. Even in a moderate recession, demand still grows. And yet the supply challenges next year and the year after are only getting worse. Plus China from demand, they're very clearly signaling, demand normalization. We're seeing the demand for air travel, admittedly from a low base, but it's up like 86% or something week over week. That's normalizing. That's 1.5 million barrels per day. So I'm not fussed. And I think this concern about, my gosh, we're heading into a recession, therefore oil demand is going to fall, therefore I've got to sell oil and energy stocks. I think that fear doesn't have a basis when you really dig into it.
Okay. And of course, maybe the toughest question is, if we put these supply and demand dynamics together, where do we think we're going for oil prices in 2023? Of course, keeping in mind all the volatility.
Yeah. I call me gun shy after this year, because I did, and I thought we'd be $100 oil this time approximately. We're trading about 80, so I was wrong, and I can't give you a firm reason why that is when we look at where inventories are and what it historically would suggest. That relationship is broken down short term. So I'm hesitant to give a time and a price in the same sentence. So I'm going to talk price. I think ultimately we're heading materially over $100. And if I'm going to backtrack, I think we should see that at some point next year, maybe not January, but just the bullish setup of the end of the SPR, China normalization, maybe not an impact on Russian production, disappointing shale volume growth going forward, OPEC basically out of spare capacity, demand still growing. To me, that's really, really bullish. So you can't, I'm really trying to be careful not to allow price to set narrative. I lived it in 2020, where the more oil went down, the more bearish people got. And they would say the same reason over and over and over again, but you say it over and over and over, and you feel it stronger and stronger, but it's the same data point. So yes, we've had oil sell off. Check your assumptions. We still think demand is holding up. Maybe this Russian production surge has led to a short-term imbalance, which we can't see. If it is, it's going to be worked off. We look to next year, and we think we'll see $100 at some point. And I still go back to, if there's a chronic imbalance, a structural imbalance between demand growth and supply growth, ultimately we need the oil price to go high enough to kill demand, the so-called super spike. And we're talking well in excess of $150. That's probably 2 years, 3 years out, but that still feels like that's where we're headed as a world. But for next year, I'm really bullish on the setup. Maybe we've whatever we've given up in terms of returns this year, we've just extended it. A call deferred is not a call denied, and we remain bullish for 2023.
Right. And just to recap, at the beginning of the call, did you say your fund is up 45% for the year?
Yeah, and I feel disappointed because we were up 90, and we've fallen by half, and I can't really come up with a long list of good reasons for that. So we look at next year, the free cash flow generation of this sector is going to be historic. Companies have used this year to pay down debt to hit their leverage targets. They've largely achieved that. So next year, rather than giving money back to the banks, they're going to be getting back to us. So I continue to see dividend increases in some cases, which will blow people's minds in terms of what the dividend potential is, meaningful share buybacks, significant issuer bids, so in excess of 10% buybacks in many cases. And so we're quite bullish on why have energy stocks held up so much better than oil. I think it indicates that you're seeing a massive entrance of generalist investors finally, like something we've been waiting for years. And so as the fear of missing out, as performance anxiety, as the realization that this is the only game in town continues for 2023, I think you're going to see more and more and more generalist money coming in, driving a re-rating from valuations now, which are still at less than half of historical averages.
Right. And also important to discuss, I think, is if you're an investor, how do you approach this? And I'm going to ask the question in two ways. If you are somebody who's already involved in oil, what do you do at this moment? If you haven't yet gotten in, how do you start approaching it?
So for my clients, so not my end client, but my advisors that we deal with, I say this is not a 1 month trade. This is a 5-year investment. And you need to be prepared for bouts of volatility, at which times are inexplicable, meaning what we've just endured over the past couple of months. So long as you can have confidence in terms of where you're headed, because we can very easily measure the free cash flow generation, the ability to buy back, all of the shares outstanding in some cases in 3 and 4 years. And we have certainty for so long as boards adopt that philosophy, which they all have. I'm fairly confident in the end result that is going to have from a performance perspective. But you've got to have that conviction, because you can have a drawdown over the past couple of months and you sell and you just get shaken out. So my own belief is this is a multi-year bull market for oil. Energy stocks remain profoundly mispriced. ESG pressures are alleviating in real time, and you're seeing even ESG funds trying to figure out how do we get oil and gas into our funds, because why? Their performance stinks. And as a fund manager, the only reason my clients don't fire me, which they can do with a click of a mouse button in 3 nanoseconds, is they have a belief that I'm going to make them money. And ultimately, all fund managers, ESG or not, fall under that necessity. So yeah, we remain bullish for 2023. We think the meaningful return of free cash flow in the form of buybacks and dividends can re-rate stocks from generational low valuations. We're bullish on oil going forward. And so it's not often where you can take advantage of a pullback where guys, and it's not just me, but we've got pretty good access to people that we speak with, and very few can come up with a concrete explanation with confidence in terms of justifying the drawdown. So we think the macro remains positive, stocks remain inexpensive, and we can identify catalysts in 2023 that we're optimistic can drive the re-rating and share price valuations.
Okay, as always, I think that was a great summary of something that is very complicated. A lot of great information for investors. Thank you so much for going through it with me today.
My pleasure, and happy holidays, Merry Christmas to everyone. Looking forward to a very good 2023.
To you as well. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Eric Nuttall with 9 Point Partners.